Hi everyone, my name is Alex and welcome to my YouTube channel. If this is your first visit, then welcome, and if this is not, then welcome back. Today I'm adding to our series around cash flow and I'm talking about ratios, and I'm just before we start the yawning process and that dreaded gut feel of, oh my God, I'm revisiting my year 11 and 12 maths and I just can't stand this feeling. I'm not going to get too technical, so don't worry too much about it. I'm just going to talk about the importance of actually having them and why we probably need them. So let's start this off. Why do we want to be talking about things like ratio, especially since we've done things like benchmarking and we've actually tracked our business against other businesses? Like, benchmarking is a fabulous tool and we need to do it as part of the all-round cash flow of our business and monitoring our cash flow. Benchmarking is important. It means that we're comparing ourselves against others in the industry and we're tracking our KPIs, and hopefully we're kicking our goals and we're making sure that we're checking in on our strengths and weaknesses from an overall business perspective. But it is looking at the overall business, not necessarily at our cash. It's looking at the things that we do and provide. So that could be like the service, our turnaround time, the number of clients that we have, the number of headcount that we have, all those kind of non-cash items that all drive good cash flow and great performance, but aren't necessarily checking on the financial health of the business and making sure that we know exactly what's going on in the business. So this is where ratios become really super important and super helpful. And most software will do it for you. So if you have a Xero or a QuickBooks or something along those lines, a lot of these ratios, they will actually calculate for you. So provided your information that you're putting in is good quality, and provided that you are up to date on your bookkeeping and you are making sure that everything there is ticking along nicely, then you should find that the ratios that you can dig out of your software is actually really useful and really accurate. And what the ratios will do is they will actually tell you about the financial health of your business, and it will tell you whether or not your business is performing on a financial level based on different metrics within your business. I hear objection about this all the time because a lot of business owners will say, but I know how it's going. I have a gut feel. I know what my gut is saying. Well, that's really great, but it comes back to the same point I made a few weeks ago around whether or not it's actually tangible if it's in your head. So an idea is an idea as long as it's in your head. It doesn't become a plan until you write it down and tell people about it. The performance of your business is a gut feel until you actually sit down and look at it and look at bang smack in the eye, because your gut feel may be very wrong. It also, generally speaking, comes with experience. So in your first few years of owning your business, you may not actually be that in tune with what your gut should be saying. Your gut might be very different to the reality. And so this is a time when you need to be really focusing on what it is that your business is doing well and what it might not be doing well, and what you need to focus on financially to make sure that it is doing well in the future. And this all comes back to helping with your cash flow, because at the end of the day, if you have a cash flow problem, which many businesses do, it's because there's something going on in your finances that you are not aware of, or you're not seeing clearly because you're just not seeing the wood for the trees. I would love to give you a sideline story about how interesting this part of the process is, but in actual fact it's not. This is actually part of running your business. It is actually quite technical, and it's not as sexy and fun as the rest of the running the business piece is, but it is really, I cannot stress this enough, it's actually really important, because it really will tell you how your business is going. So let's start at the top, current ratio. So this ratio is really super easy to work out. It's based on your current assets and your current liability. It measures your business's ability to pay short-term debt and achieve long-term goals. Now, there again is nothing scientific. So if you are looking at your balance sheet, which your accountant has provided for you when they have done your end of year financials, you need to look at the current asset number, and then you need to look at the current liability number. The next ratio is called the quick ratio. It's a little bit more stringent than the current ratio, but it is equally quick and it is equally easy to work out. And it measures the business's ability to meet cash obligations in the short term. And it basically takes current assets minus inventory and compares that with current liabilities. So again, the same sort of numbers on the balance sheet. Now, if you are a business that doesn't have any inventory and you don't have any WIP and you don't have anything along those lines, then it's going to be much the same calculation as it was for your current ratio, because you just simply don't have the same business factors as other product what say product-based businesses might have. The next ratio is the accounts receivable turnover ratio. Now this ratio measures your credit control and the amount of time it takes for you to actually turn over your credit function and how much you're earning money and how quickly you're earning it. And it really simply looks at your accounts receivable and how quickly it takes for it to turn over. So that is the number of days. The next ratio is to do with days sales outstanding, and that is simply how long it takes people to pay you. What is the average period of days that it takes for people to pay you? So for example, in here, we actually operate on cash on delivery. We require immediate payment. However, we do have clients, especially our business clients, are on 12-month payment plans, and there are other clients who do take a couple of weeks to pay. So our average is probably more like a week than it is on immediate delivery. So the next ratio is the working capital ratio. This looks at how efficient your business is in making your working capital actually earn you money, and it looks at your total turnover, your current assets, and your current liabilities. The higher the number, the better the use. The next one is gross profit margin, and this one uses total turnover and gross profit, and you use it to create a percentage, and it tells you how efficiently your business is actually using profit to generate turnover. The last one that we look at frequently is the operating cash flow ratio. This ratio looks at how well the business is actually using cash to generate activity in the business, and it takes your current cash flow and total debt and compares the two to get to the ratio. So very, very easy ratios to apply. There aren't really that many that, like I said, there are dozens out there that you can choose from, but there aren't really that many that I would say to keep an eye on a frequent basis. How often should you be looking at these ratios? Well, I would say be looking at them at least monthly, just to see what's going on. And if you're not looking at them monthly, certainly no less than quarterly, to be able to see how your business is performing, because you want to be able to make changes quickly, because changes, especially in the cash flow space, can actually magnify really, really, really quickly. So what may have been a 1-month problem can turn into a 2-quarter problem really very, very quickly. What if it's not a good news story when you look at all your ratios? Well, that's the whole point of looking at the ratios, is to see whether or not it's a good news story. If it is a good news story, then great, keep doing whatever you're doing, keep measuring your ratios, making sure you're ticking away at everything, focusing on what needs to be focused on. If not, then you know where you need to be looking, you know what you need to be doing to change things. So for example, let's just say your daily sales turnover is very, very high. That means that you're not collecting on the cash in your business quickly enough. Well, then you need to go on and you need to improve your credit control policy. You need to chase your customers up more quickly. You need to be generating some activity in that space to bring money in the door a lot more quickly to help you in terms of keeping that cash flow rolling and keeping everything going. Again, your software can do this for you, but many, many accountants, us included now, do this as part of our virtual financial services offering. We will actually do this for you and make sure that we keep on top of it, and we'll just bring you the short notes at the end to tell you how everything is going. It's not fun, it's not sexy, it's very, very boring, but it is a part of the business that really does help you understand which bits of your business are performing and where they're not. And this is especially helpful when you have a problem, but you're not 100% sure where that problem lies, or you have a gut feel where the problem might lie and you want to know what the extent of that problem might be. So I hope you've enjoyed it. If you've got any comments or you have any thoughts on the topic of ratios, even if it's to say I hate maths, then please do feel free to put it in the comments section below. If you would like to talk to us about becoming a client, I will add all the information that you need into the description bar. Otherwise, please do like our channel and click on the bell so you receive notifications of when we put up new videos. Have a great day.